newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. There's a lot to digest in this market picture. We have a lot of weak data from last week. We're now starting to talk about a change of guard over at the Federal Reserve as well. How do you price that all into a market that's still kind of keeping up, or catching up, I should say, to the tariff picture? Seema Shah, Chief Global Strategist over at Principal Asset Management, joins the program first thing this morning. Seema, pleasure to have you. Walk us through that narrative here. I think it took everyone by surprise, that economic resilience story of the United States in one quick data print feels like it didn't exist to the same extent that we thought it did. What do you make of the revisions number from Friday?
Thanks for having me on. It was a real shock, I think, to see those numbers. And I think over the weekend, I think there's been a lot of digestion. And then remembering that the key thing here is also that there is a labour supply dynamic at play too, which could mean that, a lot of the drop in payrolls that we've seen is not necessarily just down to labour demand, but a lot of it is labour supply in play as well. So it is a really, really conflicting, confusing picture, I think, at the moment. We've already seen that through a lot of the economic data over the last couple of months, and now it's spreading to labour market data. So I think for the Fed, although it's certainly a clearer picture of weakness than maybe certainly Powell had anticipated last Wednesday, but I don't think it's that clear still, because, we still have to wait to see what happens to inflation. And of course, there's the next employment report. So I think still a lot to be seen at this point in time. When
it comes to how the Federal Reserve maybe processes it, reacts to it, how do you price in some of the volatility that may be coming from the changing of the guard at the Federal Reserve?
Right. And I think this has this whole nother dynamic of what is to come. From our perspective for next year, we are anticipating more rate cuts. The timing of that is going to be difficult because, of course, it depends who's going to come into play, when they're going to come into play, and then also how vocal they are. If they are who's going to be very vocal, trying to lead the market in a more dovish stance, well, then I think the market is going to react. The bond yield is going to move down, even as maybe central bank rates don't move down so quickly. So I think there's still, as I said, there's a lot of conflicting signals at the moment. From a market perspective, we're trying to look through all of that noise, trying to say, well, what are we going to expect a year from now? Where is the economy going to be? Where are rates going to be? We do think rates are going to be lower. Not significantly, though, partly because we still do believe a picture of general economic robustness. So weakness certainly to come into play, but we're not looking at recession. So there's kind of four rate cuts that I think the market has been pricing in until Friday. That, to us, looks about correct.
So still strength is what I'm hearing from you, at least in the next 12 months or so. Where does the tariff picture ultimately fall into that?
I think the tariffs are clearly going to have an impact. And I think that's been one of the things that the market has been tripped up by in the last few months is that, well, actually, you haven't seen the economic data respond. You haven't really seen the inflation data respond. So I think the market had some complacency leaking in. Now, with a lot of the uncertainty, at least some of it being cleared up on Friday, we can now start to think about how does the macro picture respond. There will be some impact. Someone is going to have to pay for these tariffs. It's either going to be the U.S. consumer or the U.S. business, most likely. And then you start to see some slowdown coming down the way. But again, we don't think it's going to be as severe as what was being priced in back after Liberation Day. So for us, it's about a 1.6% hit to growth. That is very specific, and I think that almost exaggerates how clear it's going to be. But certainly some downward impact on growth down the line.
All right, Seema, hold that thought. I want to bring in our reporter out of Zurich, who, of course, is monitoring one impact of this tariff picture. Of course, we're seeing Swiss stocks really pricing in the pain that Switzerland is at least anticipating is going to kick in August 7th. A 39% export tariff rate, one of the highest in the world at the moment. Our Swiss bureau chief, Jan-Henrik Forster, is all over this story. Jan, can you just walk us through, for our global audience, the dynamic between the United States and Switzerland right now?
So on Liberation Day, when Trump announced the U.S. tariffs, people were surprised that they were so high for Switzerland. It was 31% at the time. Since the Swiss government has given the impression that the relationship with the White House is actually quite good and negotiations are going very well. The Swiss were saying, look, we're going to invest more in the United States. We are a big employer anyway. We are a big investor in R&D. And apparently Trump didn't really care too much about this. He was mainly pointing out the trade deficit, the big surplus. Switzerland is a big exporter. And that really, in the end, the conclusion was that the relationship wasn't as good as the Swiss thought it was. So now we had this tariff announcement on the Swiss National Day, 39%, which is by far the highest of all Western economies, and certainly higher than the European Union, the other trade bloc here in Europe, or the main trade bloc. And that was a big surprise. Now, market reaction today in Switzerland is muted. Negotiations might be continuing until the end of the week, so there's still a bit of hope that the Swiss can hammer out some concessions. One is, for instance, importing liquid gas from the States. That would be one thing. And then there's also the pharma industry, which is pledging investments into the United States. So there's still a bit of hope, I guess. And then really the other aspect is that Swiss companies are very good at defending margins, right? We've seen that. The companies here constantly deal with a strong currency. So I guess it's also, the market reaction is also a bit of a realistic reflection of what people are used to here in Switzerland.
Jan-Henrik Forster there in Zurich, walking us through some of those dynamics that we've got to keep our eye on. He also, and I'm sure, is monitoring very, very closely the fact that one of the key kind of complaints that Donald Trump has against the Swiss is the fact that their rates are at zero. And they have actually been talking about moving the currency as well, intervening when it comes to the Swiss franc. And we get that right. Still with us, Seema Shah, Chief Global Strategist over at Principal Asset Management. Jan-Henrik used a key word there, negotiation. There is a sentiment that even if 15% or potentially 39% or whatever the number is that is applied to these rates, as long as you have clarity on what the number is, it is actually a good outcome and that the volatility is worse. Does that apply to all figures?
Well, look, I think one of the key things that's been weighing on markets to some extent is the fact that there has been a lack of certainty on where tariffs are going to end up. So at least knowing something of where it's heading is good news. I don't think this is the end of the road, though. Certainly, we're expecting continued negotiations even this week. And then looking beyond that, we've still got the legal challenges to be cleared up. We also think that there's going to be increasing pivot towards sectoral tariffs, which I think is going to be really key for Switzerland, given the focus on pharmaceuticals. So, I think the lack of, at least the clearing up of some uncertainty is positive. But when you're looking at a tariff of 39%, I think you prefer to have a bit more uncertainty, knowing that there's a potential for it to come down.
Absolutely. Talk to us a little bit how this shows up in the currency space, though, because there has been this long narrative for about, at least since Liberation Day, but certainly for 6 months now, that you want to be structurally underweight the U.S., or at least structurally neutral towards the U.S. Does that still apply in a recessionary scenario?
Well, so historically, we've always seen that the U.S. dollar has strengthened in that kind of environment, especially if it's a global recession. Now, what we've seen actually in the last couple of weeks is those concerns around the dollar, the weakening, has started to subside. Concerns that, maybe there's going to be further criticism of various institutions has started to subside, and that's been almost putting a kind of a floor under the US dollar. I think that's going to continue. I think what we're likely to see now is that as we get into the last couple of months of the year, we start to, maybe see some of the other countries weakening further. You could see the dollar stabilize. I wouldn't expect any strength at this point, but certainly it does seem like that downward path in the dollar is mostly played out.
There is a question, though, of if it's mostly played out, then what kind of tactical reversal do we kind of see? Who benefits, or who loses from that? If you see a reversal in the dollar, for example, who does that come at the expense of?
Yeah, we've had a couple of concerns about the euro area. I mean, look, it's done incredibly well this year. We do think that it's been justified. But at this point, again, similar to what we've seen for the US dollar, a lot of that good news is played out for Europe. So on the other side of US dollar stabilization, it might be that you start to see euro weakness, a little bit of euro weakness. And actually, if anything, I think that could be really good news for the euro economy. We've seen so far from this earnings season that the strength of the euro has been weighing on a lot of companies. So there's always going to be a balance for any currency when it's in terms of the good news for the country. And I think for the euro, we're probably hitting a point where actually a lot of people would welcome a bit of weakness.
In terms of the pound, how do you think about the UK and exposure to the UK, whether it's the pound, gilts, even the FTSE 100? Where does the UK fall into that global allocation?
Yeah, it's been an interesting story for the UK because it's going back and forth. There's been so many concerns from a domestic side. Sorry.
No, don't worry about it.
But at the same time, there has been, I think, continued concerns over what happens to the fiscal picture, what happens to inflation, where the Bank of England is going to go. The UK has benefited, on the other hand, from just being a bit of a defensive play. A country which has not fallen in the line of sight for President Trump. It's got a fairly good tariff deal. So, I think the UK has benefited as companies are trying to look, or investors are trying to look for where is stabilization, where is defense. But overall, from a macro picture, we have a fairly negative view over a 5-year period.
So I'm having a little bit of deja vu from the first Trump administration, where we weren't really talking about trade deals with as much focus on Europe, the UK, Switzerland, Latin America. It was really all about the U.S. and China at the end of the day. And I'm curious, with those ongoing negotiations, is that the next kind of pivot point when it comes to global allocation, that ultimately you have to wait for the nitty-gritty that comes out of the two largest economies in the world?
I think that is key, but we are expecting that we've almost finalized that part for China. It's going to be that focus on sectors. Which are the sectors which China is going to be most exposed to? What is going to happen to the semis? So I think there is something to play for. With China, actually, the key thing that we're looking out for is how are policymakers going to intervene? Do they continue to see weakness, which prompts them to believe that actually there is a strong case for some kind of intervention? But overall, we're actually feeling more confident on the idea of investing in China going forward. And as a result, actually all of Asia, parts of emerging markets, looking a lot more attractive for us in the last couple of months.
All right. Seema Shah, Chief Global Strategist over at Principal Asset Management, taking us on a tour around the world. We thank you so much. I want to bring it right back to kind of where we started the conversation, though, around how we should be interpreting monetary policy in this environment. President Donald Trump saying he will announce a new Federal Reserve governor and a new jobs data statistician in the coming days.
I have a couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who is a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
Now, Trump has faced criticism for his relentless attacks on the Fed and for firing the Bureau of Labor Statistics chief after data showed weak jobs growth. Bloomberg's Valerie Teitel has been following the story for days now. Val, how do you make sense of these movements?
It was some of the steepest revisions that we've seen from the BLS when it came to the non-farm payroll report on Friday. Going all the way back to 1979, we've not seen as steep downward revisions in these payroll figures outside of recessions, which are notoriously very hard to collect data in. But it puts the 3-month run rate for NFP at 35K, which is the weakest jobs market that we've had since the pandemic. The May and June figures revised down into the teens, Critty. Some very steep revisions. This led to a huge repricing in front end. We saw the biggest move in 2-year yields that we've seen in over a year on Friday, dropping around some 28 basis points in the session, as now the market has it went in at some point on Friday to price that Fed cut in September with more certainty. Now that odds are hovering around 85%. We also, it was a very busy Friday. We also had the announcement of the Fed Governor Adriana Kugler resigning. Now, remember, this was a candidate that did not vote in the meeting on Wednesday that had those 2 dissents. She resigned on Friday after the weak payroll print. So a lot of curious, conclusions about the timing of her stepping down. But it does leave that seat open, wide open for President Trump to fill, hopefully, maybe even before that September meeting, for him to have some sort of influence on the Fed's next decision. Critty.
Something we're watching very, very closely. Bloomberg's Valerie Teitel walking us through the dynamics over in Washington. We thank you so much. Coming up on the program, OPEC Plus closes a 2-year chapter in its oil strategy with the last in a series of bumper output hikes. We're going to dive into the details next. Stick with us. This is Bloomberg. Oil prices fluctuating after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply as countries wrestle with the impact of U.S. import tariffs. We're seeing Brent crude trading at about $69.50 a barrel. Joining us for more on this Middle East energy markets reporter Anthony DiPaolo, all over this story. Anthony, just walk us through the details of this OPEC Plus decision.
Yeah, good morning, Critty. Basically, OPEC Plus had a select group of the countries there, 8 of them, had taken off voluntarily about 2.2 million barrels a day of production. And what they're doing is they're unwinding those cuts now. They're bringing that oil back into the market. That won't bring all the OPEC Plus oil back to the market because there are still cuts in place. That will be the next phase of what they need to decide on. But what they're doing right now is by September, they're going to have unwound that first round of voluntary cuts. Again, that's 2.2 million barrels that they're bringing back to the market. And that's a lot faster than they had initially planned to do. They initially planned to take a full year more before they brought that oil back to the market. But OPEC has assessed a couple things. They've assessed that the market is strong enough to take all that oil back into the market. Plus, I think they've decided that they want to have market share. They don't want to give up that market share to those other non-OPEC plus countries that are continuing to produce and increase production and put more barrels into the market. They want to get some of that market share back for themselves, even if it means slightly lower prices. They're also taking the temperature of the room and saying that Donald Trump wants lower prices, thinking that prices are going to go that way anyway, so they might as well get some more barrels out there and get a political win from giving Trump what he wants. Of course, prices are not as low as the president might want. They're around about $70 a barrel today. And so one of the surprises is that prices really have held up in the face of this added supply coming to market. And that's because we've seen really strong demand through the summer from gasoline, from diesel, from jet fuel as people travel around. The clouds that are kind of on the horizon, though, are of the prospect of declining demand as we get into the winter months. So as we get into that summer peak, a little bit less demand. As that oil comes to market, maybe we get some buildup and some lower prices. So that's the risk that the market is looking at, Kriti.
Well, Anthony, you talked a little about it from a supply perspective. Talk to us from a demand perspective. Why is oil not lower in the face of some of the deteriorating economic data that we've seen? It's been a major theme here that perhaps the cracks from the tariff war have actually started to show up on the surface. Oil doesn't seem to be budging in the eyes of, or in the face of, I should say, weaker payrolls, deteriorating manufacturing data, when he traditionally has been sensitive to that in the past.
Yeah, it seems like a lot of that data is waiting to see, really waiting to project what those results are. And the market is also waiting to see how the data is going to reflect what's happening. So we haven't really seen what people thought might be the worst impacts of tariffs, of a trade war. So as those deadlines as well have been pushed back until the tariffs have been implemented, and we've got different signals coming about what they're going to be, what products they're going to be on, what the levels are going to be. The market hasn't really decided yet, and we haven't seen the full impact of those in the data yet. So that is perhaps kind of a lagging result that we're going to see going forward. And it could be that we do see negative information just as all that oil hits the market and just as that demand starts to get out of this peak from the summer. But right now, demand is really going strong, records every year, and that's the signal to the refiners. Margins are great, and that's the signal to OPEC to keep producing. So that's what we're seeing, Kriti.
All right, Bloomberg's Anthony DiPaolo in Dubai giving us an update when it comes to the oil picture and OPEC Plus's role in it. We thank you so much. I want to stick with the same theme with a slightly different angle. Indian Prime Minister Narendra Modi is striking a defiant tone in the face of President Trump's 25% tariff rate. He's urging citizens to buy locally made goods while New Delhi continues to buy Russian oil. Joining us now is Tony Halpin, who leads our Russian economy and government coverage. Tony, just walk us through this dynamic between India, Russia, and the United States. We know that India buys Russian oil at a much more discounted rate. It's a historical kind of geopolitical tie that's been there for decades. But walk us through the impact of where a secondary tariff or a secondary sanction, as Donald Trump has threatened, might show up.
Yes, good morning. As you've noted, India has really capitalized on the diversion of Russian oil flows away from Europe. It's now the biggest importer of seaborne Russian crude in the world, and its own consumption has gone up from almost nothing before the war to about a third of imports from Russia now. So it's very unlikely that India would simply buckle under to a demand from Trump to simply stop purchasing Russian oil, which is the drive behind his threat of secondary sanctions. The idea from Trump is that Russia will have its sources of financing for this war cut off if they can somehow reduce the amount of oil that Russia can sell abroad. And countries like India and China in particular are big purchasers of Russian oil. But as you've noted, Modi's striking a fairly defiant tone. Trump slapped 25% tariff rates on India. So India doesn't really have much incentive to do Trump a favor on the war in Ukraine. And currently, because of the long-standing ties with Russia, it's much more willing, I think, to continue buying Russian oil.
Well, Tony, walk us through all of that in the context of the fact that Steve Witkoff is due to be in Russia this week, the U.S. Special Envoy. Of course, it follows just days after there was a fairly rough exchange between Dmitry Medvedev and Donald Trump himself in talking about things like nuclear submarines. Is that a good thing that Steve Witkoff is going to be in Russia for his 5th visit?
Yes, I mean, Putin has met Witkoff on each of the previous 4 occasions, so I think the expectation there is that he will see Witkoff again this week. It will be a surprise if he doesn't, and that will tell us something about the state of current US-Russia relations and the relationship between Putin and Trump personally. But the fact that it's taken almost a week since Trump announced this visit for Witkoff to arrive in Moscow sort of underlines the sense, I think, that the US isn't really expecting to gain any concessions from Putin ahead of Friday's deadline. I think the Kremlin itself is waiting to see what Trump will do once they reach that Friday deadline. So I think probably the Witkoff visit will be as much to try and gauge the temperature with Putin, to try and understand where they might move forward once this deadline has passed and once the US has imposed these tariffs. But I don't think there's a great deal of expectation that Putin's going to make concessions to Witkoff, and he certainly hasn't in any of the previous visits.
All right, Bloomberg's Tony Halpin setting us up nicely for a big story that we're going to be monitoring this week. We thank you so much. I want to bring one more story to your attention. UN Secretary General Antonio Guterres planning to slash more than $700 million in spending and overhaul the United Nations as the United States pulls back its support. Guterres' plan calls for 20% cuts in expenditures and employment, and about 3,000 jobs would be lost as a result. President Trump has suspended funding and pulled out of several UN bodies. A broader review is expected to lead to further cuts. Now, coming up on the program, we're going to switch gears a little bit. Greek commodities firm Metlen begins trading on the London Stock Exchange today in a rare glimmer of hope for markets right here in the heart of the UK. We speak to the company's CEO about the listing, the thinking behind the move from the Athens Stock Exchange, and perhaps why he didn't pick any of the other exchanges that may be vying for his business. There's a lot to digest this morning. We're going to dive into all of it within that exclusive interview, as well as some moves from the market. Stick with us. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in London, and these are your top stories. Swiss stocks falling as the market reopens after a holiday, exporters facing a 39% tariff from the United States. And a big U.S. jobs miss and revision boosts rate cut expectations as President Trump looks to announce a new Fed governor and jobs data statistician in the coming days. Plus, oil prices lose momentum as OPEC Plus adds barrels into a market facing renewed demand worries. We're going to dive into the details. Now, Canadian Prime Minister Mark Carney and U.S. President Donald Trump are expected to talk over the next few days after the two governments failed to reach a deal before the August 1st tariff deadline. U.S. Trade Representative Jameson Greer noted that while talks are continuing with Canada, the administration views tariff rates as largely non-negotiable.
I'm not concerned that it's going to complicate things with Canada. Our view is the president is trying to fix the terms of trade with Canada, and if there's a way to a deal, we'll find it. And if it's not, we'll have the tariff levels that we have.
Our very own trade czar Brendan Murray joins the program this morning. Brendan, what do we make of this? I thought there were no extensions. I thought there were no negotiations. And now there are.
Well, it seems that heading into this August 7th, this new deadline that we're looking at, that some countries think that there's still time to get a deal. For all the deals that we had announced last week, we still don't have one with China. The one with Mexico was postponed for 90 days, and Canada is still in limbo as well. So those are the three biggest U.S. trading partners where things are still uncertain. And, of course, the European Union, their deal was written down on two separate fact sheets. So there's there's a lack of clarity there about how the two sides will come together into one formalized statement, some sort of executive order or something that lays out exactly what the arrangement is going to be going forward.
So you named Canada, Mexico. We know that China is, of course, in the background as well. Those are your three largest trading partners for the United States. What is the U.S.'s beef with Switzerland right now? We got a 39% tariff, right? You're seeing the Swiss markets reopen this morning and have a pretty dire reaction. Walk us through the trade dynamics between those two countries.
Well, as we've reported over the past couple of days, there was a call with President Trump at the 11th hour on Thursday that did not go well. And the president decided to go with this number, seemingly out of random, the 39%, to drive home this message that he wants deals that will benefit the United States, and that didn't meet the threshold from the Swiss in this case, apparently. And so he's hitting Switzerland with these very damaging tariffs. Switzerland's a big pharmaceutical exporter to the U.S. They export Nespresso coffee pods. So you could see how this can hit a cross section of the U.S. economy and the Swiss economy with these very high tariffs that he's threatening to impose.
It's fascinating. The trade story just goes on and on and on. Brendan Murray is here to keep us apprised of all of that. We thank you so much for that update. Of course, as the tariff volatility, it feels like subsides and then restarts, there's been a lot of questions about how stocks IPO trade in these markets, whether you even want exposure to the public story. Well, there's one company that has made a very interesting choice we're going to dive into. Greek industrial company Metlen Energy and Metals has started trading in its London-listed stock today. Now, the company says it will retain a secondary listing in Athens. Metlen's listing is a welcome sight for the London Stock Exchange, which has been shrinking in recent years amid frequent takeovers and a few new listings and plenty of geopolitical volatility. Joining me now is the chairman of Metlen, Chief Executive Evangelos Mytilineos joins me here. Pleasure to have you. Thank you so much for coming to join me. We have so many questions about this decision to move from the Athens Stock Exchange to London. I know you have that secondary listing there as well. Just walk us through why you chose London.
Well, in the last more than 10 years, the international footprint of the company has grown steadily. We are now present in 42 countries, and we have decided that time was right to move to a bigger exchange. And for us, determined to stay in Europe, we thought London was the best option. And we are happy that London is going to make a comeback, and we are going to be part of it.
Well, we know that Euronext has been looking to consolidate and grow bigger and bigger. They just looked at buying the Athens Stock Exchange as one example as well. I'm curious, why not pursue a European capital or a continental European capital like Paris or Frankfurt?
That's a very interesting question. If you look back a little bit, the city has been through rough times after Brexit, no doubt. And Frankfurt, Milan, Paris, Amsterdam, they have tried to take a big chunk out of the city business. But in the end, city never lost the primacy in the financial markets. Therefore, although it was the most difficult stock exchange to get in the first place, our decision was for London.
You've said in previous comments that Metlen plans to take advantage of rules that might allow euro-denominated stocks to join the FTSE 100. If that change weren't in the works, would you have still picked this part of the world?
That's a very interesting part of the whole scheme. When we decided to enter the LSE, we didn't know that there would be changes in the laws and regulations, and you could trade in euro or dollars. Now that is the case the last 4 or 5 months, and we are the first company to trade in euros. At the same time, we have seen a rapprochement between the UK and the European Union the most after Brexit. This is ongoing now. We can see it. And I'm happy that a European company, European Union company, is listing in the UK and is listing in euros. So it's a step in that direction, and that makes me very happy.
Certainly a positive one. I think makes a lot of people who are excited about London very, very happy as well. Let's talk a little bit about your business specifically, if we can. We're talking a lot about geopolitical volatility today. We're talking about trade deals. We're talking about tariffs as well. We know the U.S. has raised tariffs on aluminum to the tune of about 50%. Are you seeing an impact on your business?
Look, we're a big exporter of aluminum, but we have to consider that the U.S. is a big importer of aluminum. Therefore, for us, that makes no change, because the Americans will have to buy the same amount of aluminum that they used to buy before the tariff increase. The ones who will have to pay will be the American consumers.
And you're able to pass on those costs? You don't feel margin pressure for yourself?
No, we don't.
Talk to us a little bit then about how you're operating in the rest of the world then. If there is this idea of the U.S. has this massive consumption of aluminum or is trying to import them, would you look to broaden your exposure to other places in the world?
Well, there's no doubt that the trade flows are going to be seriously affected by the decisions of President Trump for the tariffs. But how the end game is going to be, we have to wait and see. I'm far from certain that we are going to have a nice end game, and especially for Europe, where the chance to have a good agreement was lost. We made a bad agreement in Europe, and especially I want to underline the fact that we have, according to the agreement, to invest $600 billion in the next 3 or 5 years, whatever, and buy energy, $700 billion. Even if Europe could absorb this amount of energy, the US does not have $700 billion worth of energy to sell to Europe. So probably this is an initial agreement, and we may see significant changes to the final text.
You say it's not a very good agreement. Talk to us about that 15% number. The criticism of that is that at least it provides clarity to European businesses. Do you feel like it provides clarity?
It does provide clarity because it's 15%. But I remind you that before that, it was 0%. So Donald Trump, who is a great negotiator, said I could raise it up to 30%, and then he sold it for 15%, and Europeans say, oh, yeah, great, it's 15%. No. It was 0%, and it's 15%. And the Europeans, they cannot retaliate. It's part of the agreement.
Talk to us a little bit about another place that Europeans are spending quite a bit of money on right now, and that is the defense ramp up in this continent. How is Metlen looking to get more involved in the defense sector?
In our metallurgy sector, we have been in the defense business for more than 25 years. We have a long experience. We have very close connections with all big German and U.S. primary manufacturers, and we intend to expand this business. We have already 3 plants in Greece. We are building another 2 as we speak. So this is part of our goals going forward.
All right. Evangelos Mytilineos, Chairman and CEO of Metlen Energy and Metals, joining us around the table this morning. We thank you so much for your time. I want to stick with the industrial sector. BMW going all in on its new electrical vehicle offering with the company's future riding on it. Now, the German car maker's flagship factory set to produce nothing but EVs by 2027. The CEO has been speaking exclusively to our very own Tom McKenzie about the launch, its competition with Tesla, and how the investment will shape the future of the company as his tenure comes to an end.
We're 109 years old, and it's by far the biggest single investment into one architecture we've ever done. And it kind of developed. We started with an electric car, and we said, well, it's also about digital, it's about connectivity, it's about a global approach. And then it kind of developed. And the whole company said, this is a great idea. And because everyone kind of wanted to contribute to that product. It kind of became a self-fulfilling prophecy to start that, and everyone said, this is the right time and the right investment and the right approach. And then the investment is almost an outcome of that approach. But our investments already peaked last year, with more than 10 billion euros into that platform. We're coming down now, and we are absolutely sure with the first responses we get from the capabilities of the car that this will be a very profitable future for BMW.
The iX3, deliveries in the first quarter of 2026.
Yes.
In terms of volumes, what would be a success for you by the end of next year?
That the market share which we gain together with the brother of this car, there's also the current X3, which is a combustion engine car and a plug-in car. And this brother or sister car, that we will have increased market share when they're together on a global scale. That's our target, and that's more than a wish.
What are the vulnerabilities of Tesla and your Chinese competitors right now?
I mean, when you drive the car, if you measure the car, if you see what this car can do, this will be the benchmark of the industry. This will be the benchmark of the industry.
On Tesla specifically, we've seen their sales plummet in Europe, in Germany, double-digit drops, in France, double-digit drops. You can take market share. You will be taking market share from Tesla. How much market share do you expect to be taking from them?
When you bring the newest technology into the market, you have the first mover advantage because you cannot bring every year a new car. So when you launch a car, you have the first mover advantage. So when this car is being launched in terms of charging speed, in terms of range, in terms of energy usage of the car, it will only use 15 kilowatt hours per 100 kilometers. I mean, this is the absolute benchmark in that industry. And we will use that first mover advantage at that point in time to say, well, there is a car brand, namely BMW, who can build superior electric cars. And the rest the market has to answer. We think we have a very strong brand. We have a very high quality recognition in the market. Yeah. And from the first car we built, this will be BMW quality. And that is not only a first mover advantage, this is an advantage to every who is new in this industry.
To be clear, you think the pendulum swings back from Tesla to BMW. We did a survey in 2019, 5,000 drivers. A lot of them were swapping up BMWs for Tesla Model 3s. Right. The pendulum now swings back to BMW.
Well, this is already happening in 25. I mean, in Europe, we sell more electric cars than the competitor. This is already starting before this car is even launched. So when this car is being launched, that momentum will even be accelerated because you already see it with the previous technology.
Tom McKenzie there speaking to the BMW CEO, Oliver Zipse. Now, Bloomberg has learned that Indian energy company Adani Group is exploring a tie-up with Chinese EV giant BYD. Sources saying the deal would allow the corporation to manufacture lithium-ion batteries in India. The move would extend Adani's push into clean energy, which is already India's largest renewable power producer. Now, coming up on the program, the Swiss stock market sinking today after Donald Trump's surprise announcement that the country will receive 39% tariffs on exports. A little bit of a catch-up story over in Zurich. We're going to dive into it. Stick with us. This is Bloomberg. The UK's Financial Conduct Authority is to consult on a redress scheme for motor finance customers that were missold car loans, which it estimates could cost lenders at least £9 billion. Now, the announcement comes after the UK's top court handed a big boost to banks on Friday, reducing the worst-case amount they would need to pay out in compensation. We're joined now by the FCA CEO, Nikhil Rathi, joining me right here on set. Thank you so much for your time this morning. Can you just walk us through the math here? The £9 billion to £18 billion estimate, how did you get to that number?
We've acted within 48 hours of the Supreme Court passing their judgment on Friday, which gives clarity around the law, particularly around the criteria that should be used to decide what an unfair relationship is between a lender and the consumer who buys a car. We now need to take that and, as we consult on our redress scheme, figure out which agreements are inside that scheme, what the methodology is going to be for calculating compensation, what the interest rate is, and what the take-up is likely to be. When you consult on a scheme which potentially affects millions of people, there's necessarily at this early stage going to be a range. We wanted to give a ballpark for what we did, the minimum we think it would be, so the market could understand where we are. Now, that will obviously get refined as we do this work in the next couple of months. There will be operational costs, something like this, which affects potentially millions of people. It will inevitably, in terms of operational costs, cost several billion pounds. And then you have to think about what the potential compensation levels could be, which we'll be working through in the next couple of months.
Well, talk to us about how and which firms end up paying for the compensation ultimately. Who does it fall upon?
The scheme we're looking at is a lender-driven scheme, and we've been working with around 41 lenders to understand the scale of the issue. They cover around 90% of the motor finance market in the United Kingdom. There were 25.6 million agreements on motor finance between 2007 and 2020, of which around 14.5 were so-called discretionary commissions, where the dealer could adjust the interest rate based on the level of commission they had. And there were also some agreements that may be unfair, the Supreme Court said, where there were fixed commissions or non-discretionary commissions. So it's a wide range of the market. Each firm will need to estimate for themselves what the impact will be, because they all had different practices here, and some of them will have more agreements that were potentially breaking the law or breaking our rules, and therefore will need to compensate, as compared to others, and practices changed over time as well.
In terms of, break down those lenders a little bit further from us. You mentioned over 25.6 contracts, a million contracts. Walk us through how much of that, in your perspective, is non-bank institutions versus your traditional banks.
So I don't have that data to hand, but what I'd say is that you have some banks who are very active in this market, and you'll have seen some of the market statements this morning, some large banks, some medium-sized banks. In the new car market, often the motor manufacturers will be dealing with what they call captive lenders, so their own lending businesses, and they are often the vehicle through which lending is given for new cars. And then you do have some other smaller lenders as well that might deal with niche parts of the market. This is an enormous market. It's the second biggest consumer credit market in the UK, so there's a very wide range of players. When we consult in October, we'll put out a lot more detail around the institutions affected and the different types of contract we're dealing with.
Well, let's talk about another player in this conversation. That, of course, is the UK government itself. There has been concern when regulatory authorities kind of ultimately clash with the UK government's commitment to invest, commitment to growth in the UK. Are you concerned about that clash with this particular situation?
We've said all along that as we think about a redress scheme, we want to make sure there's a healthy, competitive, functioning motor finance market in the future. 2 million consumers a year rely on motor finance to buy a car. And we're confident we can put a redress scheme in place which continues to ensure that market functions. But we also have a consumer protection objective and a market integrity objective. And the Supreme Court has now ruled. And if the law has been broken and our rules have been broken, as we believe has been the case in many agreements, there needs to be appropriate consequences and appropriate compensation for those consumers who've lost out, so they have trust in the market as well. And we think we can achieve both.
Well, talk to us about that compensation or those payouts as well. How many consumers are we talking about? What kind of timeline, what kind of payout can we expect?
We're going to have to work through the numbers. I gave you the numbers of the overall agreements, but not all of those will qualify. We've also said we're going to consult on a de minimis threshold, which is where there's very small amounts of commission. They may not be included in our scheme. We would like industry to cooperate with us now. The Supreme Court has ruled. We'd like to work closely with industry so that we can get on and design the operation of the scheme, promptly over the next few months so that payouts can start next year. That gives consumers the certainty they want, but it also gives firms the certainty that they and their investors have been asking for. So my message to industry would be now, work with us. Don't try and argue over every technical point because it will just slow things down. Let's get this up and running and operationalized and get the certainty we're all after.
All right. The FCA CEO Nikhil Rathi joining us this morning on a crucial historic morning when it comes to that motor lending case. We thank you so much. I want to go to another major story in the transportation space. I think we can loop it all under. More than 3,000 Boeing defense workers have gone on strike for the first time since 1996 after rejecting a 20% pay rise. I want to bring in Bloomberg's Danny Lee, who's been covering the story for us. Danny, walk us through the implications for Boeing when it comes to this strike.
Yeah, Critty, good morning. So this strike is now a little under 4 hours in, affecting defense machinists, unionized defense machinists in St. Louis, Missouri. And it's the first time, as you said, they've gone on strike since 1996. And the last time the workers went on strike was for 99 days. It's not so clear this time what kind of resolve the workers will have, but this does indeed affect and a little bit Boeing in the near term, particularly the defense space and security unit, which it falls under, which has been struggling for some time now. And particularly, it is an important part of Boeing's business that generates around a third of all of its total revenue. And in the past 3 years has amassed operating losses to the tune of $11 billion. So how did we get here? It's indeed the workers, the union workers, which rejected a 20% pay increase that would have lifted pay to around $103,000 a year from $75,000. This vote was struck down twice by the unionized workers because of contention around pensions and overtime, amongst other things. So there is a bit of a frustration for Boeing. But when you look at how important the unionized workers are, they do play a key role in building the F-15 jet and the T-7 training jet and building munitions and missiles.
All right, Danny Lee, giving us a little bit of an update on that Boeing strike. We thank you so much, walking us through that crucial component as well. We feel like we get a lot of strikes from Boeing. We'll see how much of this change this makes, and of course, how it shows up in the pre-market. In the meantime, we've talked about these futures here because we are counting down now to the U.S. Open as well. And remember, there is some green on the screen when it comes to the futures picture on both sides of the Atlantic. We're going to put Switzerland off to the side for just one moment in terms of the underperformance you're seeing there. They're playing a little bit of catch up to all the bad news coming from Friday when it comes to the payrolls report, the risk sentiment, the tariffs, et cetera. But right now, a little bit of a rebound story for the S&P, higher by 0.6%. You are seeing outperformance in the NASDAQ, so a slightly defensive tilt when it comes to the futures picture. In the meantime, when you look at European indices, though, it's a similar story, green on the screen, but not seeing as much buying with that same margin, unless you look very specifically at the DAX. And that's really the one driving the trade this morning, higher by 1.3%. Overall, the FTSE kind of lagging here, only up 0.5%, but certainly one we're going to keep an eye on. We are keeping a very, very close eye on the Swiss market, down about 0.5%. Pain when it comes to the Swiss market, digesting 39% of exports, the 17 companies that got the letters from Donald Trump, and of course, the payrolls report from Friday. That does it for the Pulse. Bloomberg Brief is up next. Stick with us. This is Bloomberg.